Good morning, ladies and gentlemen. Well, by my calculations, the risk dial is at about minus 30, but I am in no way bearish of risk assets, and I will explain to you why. The most important thing is that we've made great progress on the site, and we now know everything that's wrong, and we're fixing it. So we are within a month or two of having a completely working site with everything added to it. So please bear with me. I know it's been a long time, but we are working on it, and it's going to be well worth it. As always, we start our review with the yield curve. The yield curve is basically stuck. This is 2s10s. It's stuck around zero, and basically everything is flat. Now, to me, a weekly trade below minus 10 and a close below minus 10, don't look at these spikes. They never happened. It's just, this site is not very good at following the yield curve, but it's all I've got. And really, I think it's likely to go negative, and I think it's likely to go more negative eventually, but I don't think the time is now. As always, I follow price. I have my macro view, and my macro view is that eventually we will have for a short period of time lower inflation, but then higher inflation again. But I don't think that is going to be enough to stop the Fed from tightening, and eventually the Fed is going to have to tighten much more to kill inflation, i.e. get short-term rates around the 4 to 4.5% area, because I just don't believe that we're going to go into recession straight away. I'll explain to you why later on, but to me the yield curve at the moment, and really 2s10s is going to be much more important than 5s30s, I believe, for the time being. As long as it stays above minus 10, I don't think it's signaling anything at all. And here we have the other components. Let's start with the 10s30s. The 10s30s are basically stuck. Okay, they are in a trading range between 24 and, let's call it, 8 basis points. So essentially we are stuck. I think we're going to be stuck for quite a while before we get a move, and 5s30s similarly, they are stuck basically. We are stuck around 20 basis points towards 0 basis points. It keeps on going up and down. I don't think it's significant. What would be significant is a weekly close above the red line. And that is a negative 10 basis points, negative 11, let's call it. That would indicate that there is a lot of pressure at the front end. I think that there is more likely to be reflected in the 2s10s rather than the 5s30s. Put it this way, if we go up here in the 5s30s, God knows where we are in the 2s10s. We've got to be negative 20, negative 30. And that means that the short end is really flying. Why would euro dollars fly? Why would the real short end fly? Well, because the Fed is going to have to tighten much more because CPI is much higher than expected. What is the likelihood of that? We will look at oil prices and DBC later on, and in a period where they are consolidating to be collapsing, it's unlikely that we get a CPI print which says that the yield curve has to go negative, has to go inverted, and that the Fed really has to accelerate. In which case, I can't see that there is going to be that much pressure to go through that line. I think it's much more likely that we range trade and possibly come off slightly. So it's, that is my macro view at the moment. We will now look at the individual tenures, and I will tell you what I think is most likely to happen to each one of them. Let's start with the fives. I still believe that we absolutely top ticked it here at whatever that is, 359. Absolutely top ticked it. And you can see how it's now in a range. Whether the upward bias has to be to fill these gaps here around 338 or not, I don't think that really matters. What to me matters is that I don't think that we are going to have increasing pressure on rates for the time being, simply because I don't believe that CPI is going to accelerate. Wednesday will tell me if I'm right or I'm wrong. I think the risk reward is that CPI starts, not surprising, but starts being as expected, rather than higher than expected. That to me is the risk reward at the moment, seeing what oil is doing, the energy complex, and also copper and all the other industrial metals. And if that is the case, I don't think the pressure is going to be at the short end. I don't think the twos and fives are going to have much pressure beyond this gap fill at 330, at 337. I will see, but to me, the most likely scenario is one where we do something like this in terms of weekly trading, i.e. we consolidate between 267 and, whatever the top of this move happens to be. I don't think the pressure is going to be for immediate more rate hikes and a readjustment of all the tenures beyond their red lines. And here we have my red line in tens, 324. I think if we see 324 in the early part of the week, Monday, Tuesday, the risk reward says to look for lower yields. And really we should be doing some sort of a call spread in futures, looking for a retest of this area here around 274. Looking at the, this is the weekly chart, why not spend a few weeks in this area? To me, that is what makes the most sense. The Fed is basically going to do, I would have thought, 75 basis point, which is discounted. I don't think they will need to do more unless CPI is something ridiculous. But the way I look at it is that even if CPI is slightly worse than expected on Wednesday, people will say, well, okay, well, next month's is going to be better than expected because the lower oil prices that we've had in the past few days will be reflected in that one if they weren't reflected in this one. The components of the CPI, the individual components, would have to show something pretty extraordinary for us to break the 324 area and stay above it. Is it possible? Of course it's possible, but the risk reward is that they don't. And therefore, I think if we see this 324 on Monday or Tuesday, call spreads in futures. Very much the same in 30s. My red line is here at 345. That is all there is to it. We get there Monday, Tuesday, call spreads. If we start closing the week through it, you just don't know how bad this is. I mean, we start closing the week through it, the next objective is here, very close to 4%, 392. That to me is unlikely, as I've said, and I've given you the reason. Very, very unlikely. I would have thought that a period of consolidation like this is much, much more likely through the summer. It's all a question of risk reward. Do I think bonds have huge value here? No, not really. I mean, I don't think they have a massive amount of value, but are they hugely underpriced? No. I don't think that either. I think we have reached some sort of a medium term equilibrium, and going sideways and testing, and gap filling lower levels towards the three and trading around 310, just like we did for many months here, is the most logical and the highest risk reward that I can see at the moment. Data would have to significantly change for me to say, okay, we're going to through 345 and we're going to this, we're going to trade 4. Is it possible? Absolutely. But I'd have to see the data before I make that call. My call at the moment is that we've seen the top. 345 was it. And, while we may retest it like we did here a few times, the, the better likelihood is to buy call spreads at that level than to think that we're going to go to, 394 anytime soon. What is Europe showing? Well, this is the Schatz, and we got right to the level that I wanted to buy some put spreads in the Schatz, and I did. I'm actually surprised that it hasn't done worse. I.e., that it hasn't gone to higher levels like here around whatever this is, 69, 68, 69 basis points. It's trading better, and I should have bought put spreads in Bobble or Bunds. I still think that the Schatz has absolutely no value, and at these levels, around the 30 basis points mark, which is where I got on board, the risk reward is for higher prices. Sorry, for higher yields and lower prices in futures. I really don't see that the Schatz has any value, and I don't see that one should be buying it for any reason whatsoever. We had a lovely gap fill here, and I think that we are much more likely to test the upside than the downside. Price will tell, but the ECB is definitely going to hike rates, and the ECB is definitely also going to say that rates will continue to be hiked in a normal manner. What that does is, to me, says that the pressure will continue to be at the front end of the German market, and that is the Schatz, and that's the reason why I got into the Schatz, even though I am not getting immediately paid. If we have a look at what the Bobble is doing, well, it came back, tried to fill this gap, and straight up. I would have thought the likelihood of, in the next week, of breaking this 120 area is quite small, for the same reason that I think that the US market is not going to break the red lines that I just showed you. So that kind of a level is where I would be neutral. And basically at these kind of levels, I am bearish futures, bullish yields. I don't think that we will break this 65 area in a hurry. And I think that any move down here is liable for a bounce towards 120. And if we look at the Bund, the Bund is also having done a very nice ABC now, pushing higher. But I would have thought that this kind of level around 145, 148 is going to be all she wrote in the short term. And why? Well, the best market to follow is the French market. Technically trades absolutely perfectly. And it's actually the market I've been making most money in this year, because it just gives me, it just top and bottom ticks every time. We're in a range, and really I would have to see a break of this 170 to feel that anything at all is significant is going on that I'm missing in the German side of things. I think that is, for the time being, unlikely. The the CPI figures would have to be very, very soft, and why would they be that soft? It's not like we're not having inflation. We will see, but I think we are more likely to see this kind of 2.205 level, and that's probably all she wrote for the French market as well. I'm going to take my my clue from these ranges. Can we come down a little bit? Yes, we can, but I don't think, if I see this kind of level, 140, I'm going to be tempted to have another go to the upside. We are in a period where the markets are going to be looking for higher yields nearly all the time. But that does not mean, just like in equities, you get 10% bounces. It doesn't mean that you can't get some significant yield moves also to the downside, also in the bond markets. Eventually, what is the game? You are looking for levels to get really good levels to get short of futures at, and this kind of level, 114 would be a godsend to get short of the French market and the German market. This is the differential between the States and Germany on the 10s. To me, this 181, 182 level is going to be very important. And if I see this 181, 182 level, I will want to buy the US and sell Germany. I don't think inflation is a worldwide phenomenon, and it's more likely to be strong in Europe than in the US. Excuse me. And therefore, I think that that this kind of level represents value. I don't think that we see another panic like this. I think the ECB is going to have to understand that a very weak euro is inflationary, and that short move, small moves of 25 are actually, they might be good for the shats, but they're bad for the bunds. I really don't see that the differential in the longer end has to be that high between bunds and 10-year notes. And I think that this 182 level represents a very, very good value for a return down towards the 150s. These charts also tell me that the likelihood of us breaking the red lines, unless there's some amazing data in CPI or inside the guts of CPI, the risk reward just isn't there. If you have a look at the 5-year forward inflation expectations, they've risen a little bit, but they're the same level as they were in January, February of 2021. Okay, so this is hardly huge inflation de-anchoring expectations. If you look at the 10-year break-even inflation rate, that is also, at the same level that we were. What is this? This is April of 2021. And also, if you look at the term premium, it's coming back down to levels that we were at in February. This, I will have a look at these dates, okay? Get this chart up yourselves and have a look at these dates. And have a look at where we were in the SPX. You will be utterly amazed, okay, how these levels coincide with what we're about to see here. Well, wow, King Dollar indeed. I mean, the differentials, the interest rate differentials haven't really moved very much, but the dollar just keeps on going higher. It just shows you that there is a lack of liquidity out there, that people prefer dollars, and there is no two ways about it. What is, in the very short term, what is worrying is that it closed with a very nasty looking doji here on Friday, indicating the potential for a move back down towards this 105 area. But, that is hardly the end of the world, right? And if we go back, really what I wanted to show you is this chart. Okay, so this is going all the way back, and we haven't been above 106.25 for a long, long time. And here we are. This is the last time we were, we'll do this. So this is 106.25, right? So we're going back to 99. Stayed 106.25, and then the next level it hit was 111.13. So just bear in mind that we are in times that we haven't seen really since 2000. And funny how, we are also having a bit of a nightmare in the bond markets that we haven't seen since 2000. Well, here we are. What is likely to happen? I think that we are unlikely now to go below 102.82 unless there is a very, very good reason. And then at some stage we spike up to at least this 111.31 level and possibly higher. But just bear in mind that every time it goes through 106.25, it goes to 111. That is another, let's call it 4% between friends. And that is the hell bearish. The fact that the dollar keeps on going up tells me, as I said earlier, that liquidity is drying up. And that is all that can be said. If liquidity is drying up, eventually risk prices feel it. I'm not saying it's going to happen this week, next week, or anytime soon. All I'm saying is that eventually it happens. So, look at what equities did in this period between 2000 and the top here in late 2002. This was a period of contraction of liquidity, and until the dollar tops, I don't think that you can exclude that you haven't seen the bottom in risk. I'm going to tell you later that I'm not bearish on risk, but not right now. But what I'm saying is that until the dollar tops, you really cannot exclude that you have not seen the bottom in risk. So if we haven't seen the bottom in risk, where is the risk reward? If we haven't seen the bottom in the dollar, where is the risk reward of shorting Euro USD? Well, it's quite obvious, having put in this hangman doji, that we're getting possibly a little bit of a reversal of trend in the next few days. If you look at these indicators, the risk reward is, as soon as we get to this moving average and this area, 104.60, 105.20. And on a weekly basis, you have these very important lows around 103.40. So you can start at 103.40 and basically finish at 105.20. That is the kind of risk reward area that you're looking for, and those are the levels. All there is to be said for it. Until the dollar turns, I really don't think that you can have sustained rallies in risk. Well, gold is a complete screw up, and having broken the 1764 level, all the pressure should remain on the downside. Now, we all know that gold loves stops, And, where, if you were a fund manager, a big player, whatever, where would you have put your stop? Well, you would have put your stop probably around these lows here. And these lows are just below 1700, call it 1695. So, a quick move down to 1680s, not out of the question, right? I mean, you can go $40, $50 without touching the sides overnight. I would leave a 1680, 1681, 1682 bid just for fun. It's not going to go down in a straight line unless CPI now, it falls apart. And even then, I don't think it should fall apart. I think gold is fairly priced. But the fact that it's below 1764 indicates to me that it's going to continue to be under pressure. We have these 50% retracements of this whole move, which comes in at 1707, and it's also coincides with 1710, which goes back many years, many decades as an important level. So that, to me, below these stops, it's worthwhile having for a return to where? Well, probably 1800, 1810, and a catch up to these weekly moving averages, and that is where the 200-day moving average also is, indicating to me that gold, when it gets squeezed back up there, it'll have another leg down, which really fits in with the bonds. If they are not going to go higher in yield, and if you get a couple of weeks of sideways trading in the dollar, you could get a quick move down to take out all these stops, and then a quick move back up to 1800 just to screw everyone. That's probably the most likely scenario. DBC. Well, funny things do happen. 24.89. I left a bid there and I completely forgot about it before I went on holiday, and wow, it got filled. Yay. Absolutely amazing contract. I mean, not a contract, ETF. Trades very well on these, on my support and resistance levels. What is there to say? Amazing chart, right? I mean, it basically closed exactly where we opened the week. And we've now gone down 1, 2, 3, 4 weeks on the trot. That is why I find it very difficult to believe that CPI is going to be above expectations. What would cause it? I find it very difficult to see what would cause that. But there you go. Where is it likely to top out? Well, my offer is at 26.93. That is where we've seen many previous highs of ranges, and we'll go back, and you can see all the way back here in 2014, 15, whatever this happens to be, this 26.93 level trades many times. So that is where my offer is, and it would make sense on a weekly basis. We are basically the Bollinger Bands are coming in. We have strong support. It would make sense for a few sideways weeks, and if we get few sideways weeks in the DBC, it makes sense that we get a few sideways weeks in the bonds as well. So if we have a look at what gold against DBC is doing, basically, it's doing one of these. Gold is now fairly priced against DBC. So unless gold goes down massively, I can't see DBC going down massively either. Although all there is to be said about DBC, I believe, if we have a look at a shorter term chart, this is a daily. You can see how we got very close to the 200-day moving average and bounced off, very much like we did here. And to me, that is, likely to be support for a while. And basically, this kind of level, high 26s, is where you should be looking for potentially the start of another leg lower. But that is a few days away. You know what they say, trade what works. Now, if we look back at what has happened in the past month or so, we got to my red lines in the bonds, and also at the same time, copper gold was breaking to the upside. And that gave me confidence to get out of my bond future shorts and even to go long, and then to get out at, and go short again in futures at higher levels. This chart of copper gold hit 1242 and back down. So it anticipated the bond move, and now it's hesitating and doing one of these, telling me that my view that the bonds are going to go sideways are more probably, reinforcing that view. That, it gives more odds. Trading is all about odds. And, if you get 3-4 things, which, especially in the spreads, which are confirming your gut feel and your macro view, it just increases the odds and makes you more comfortable with having the trade on. This to me says that we are in a range in bonds unless we start breaking hugely to the upside. But having just shown you a chart of gold, I don't think that is very likely to happen. I want to start risk basically by saying that if I don't think the bonds are going to break the red lines, I don't think that there's going to be any pressure, any huge pressure on equities. Not until we get earnings, and even earnings, I think, are unlikely to show that we are in a period. I mean, it's very unlikely that we get really bad earnings this early in the cycle. It takes time for, it takes time for unemployment to go up. It takes time for people to run out of money, and therefore it takes time for them to stop buying stuff. And therefore that is then reflected in earnings. I don't think this is the quarter, the past quarter, when that will be reflected in earnings. It's much more likely to happen going forward than looking backwards. And that is why I think there's going to be very little pressure on the equities. This level was, to me, the most important level, and 36.45, and it's been there for for a long time, probably over a year, in bold. 36.45 to me is, or 36.46 is to me absolutely the line in the sand. Weekly close below it, daily close below it, watch out. Weekly close below it, get the hell out of Dodge. You just, don't want to be around. So, what is my view? Well, my view is that since this market likes to basically screw with everyone, it is likely to do an ABC. And what are the targets of the ABC? Well, the minimum one is 40.47, which gives you these kind of level, and the maximum is 42.40. I think this one is naturally less likely, but I think it's actually unlikely. But I think 40.40 is more than likely. Okay, 40.46, 40.47 is more than likely as an ABC. Not because it's an ABC necessarily, but also because, as I told you, if you have a look at where the have a look at that chart, put it up yourself, of the term premium. You know, we got to zero in February, on the February 10th, and then again we broke on March 14th. So if we look at February 10th, where we were, February 10th whoops, looking at the wrong year, aren't I? So February 10th, we were somewhere around here. Here. Okay, we were just above 4,200, and then March 13th, we were right underneath 4,200, which was this level here, 41.26. Well, I'll call it, 41.26. We've got to put it back in. There we go. So, to me, we are likely to go just above 40.50, 40.70, something like that, if we get a decent CPI number, which allows the bonds to even go sideways. On a monthly basis, I think these levels are very, very good. Okay, I don't think we go much higher. As I showed you what my belief is, that we get to 40.50 and have a great deal of difficulty of breaking above it. But if it does break above it, the level that I short is 41.80. I mean, on a monthly chart, it is such a wonderful level. I mean, if we got there, I would be so short. I would be so long of puts. But there you go. You have the level. If we now go to a weekly chart, and I show you what is the most likely thing to happen, well, the most likely thing to happen is that we break 39.43 to the upside and then test here 41.20, or even down here, which is 40.60. So it coincides with that 40.50 level that I gave you. The question then becomes, is it 40.50 down here, or do we manage to get to 41.25? Well, there's no point in deciding now. But it's all coming together in terms of slightly better tone for risk. And why? Because if bonds do not cross the red lines and return into that range, and I've already told you that I want to buy call spreads if they get anywhere close to there. If then the term premium chart on the 10-year zero coupon bond goes to zero, as it is going, then that will allow the S&Ps to be in this kind of range. Okay, this kind of range, whatever that is, 4100s or just above, or just 40.50, I don't know, and it's really immaterial, because from here, from 3900, you've got a couple of 100 points, and I'm buying dips and I'm buying call spreads. The Nasdaq, of course, is going to reflect most whatever the bonds do. I think that if it starts trading, first of all, you will look at the bonds, and I will naturally tweet it to you. But if the bonds are doing what I think they're likely to do, the Nasdaq is likely to break this 12,440 level. And if it does that, I would bet quite heavily that it trades at least 12,786, but more probably it trades all the way to this 13,113 to 13,400 range. So those are the levels that you're looking at, and that would match with my S&P's view. Simplest way of testing it is this. And this just gives you more confidence of your view rather than gives you the absolute targets. It just gives you more confidence, nothing else. So this is where it's indicating that we go to 13,400 is the 100, and if we go through it, it will go down, it will go up to 13,100. It just gives you more confidence in your view, nothing else. It's all in the bonds, as I will show you now. SPY TLT in here and SPY IEF over here. As you can see, it just trades a very narrow range, and that basically says that equities and bonds are tied together. We need to see a break either way, and the only way we're going to see a really sizable move down in risk is if we start breaking through 330, and that would coincide with us breaking the red lines upwards in yield. Because if we move up in yield, equities are going to collapse again, because you're going to get more multiple contraction. And multiples, in my view, are much more important than earnings. Earnings can move 10, 15, 20%, even in the depths of a recession. That is not a depression. And what does that give you in terms of, move of the SPX? It gives you 10%. But, a multiple contraction can give you 20, 30% easy, which is what we've had. So to me, unless these start moving huge and we start moving through the red lines in yield, we are unlikely to really go down very hard over the course of the next few weeks and months. When can we go down? Well, we can go down when we really start anticipating that earnings are going to be crap. And that is going to be, I think, in Q4 rather than Q3. And here you have the blue angels, which have finally stopped going up. These analysts have finally started saying that earnings aren't going to go up forever. The market is fairly priced. I mean, around 16 times these forward earnings, and the multiple is not wrong. What is probably wrong is that this should be lower. These should be coming down like this. But will they come down very fast? I don't know. I still think that this area that we are trading with, this upper level here, around 4100, 4200, even 4050 is good enough for the time being on the upside. I don't think 4050 already starts to me to become more than fair. And you understand what I mean? Just more than fair. And with the risk reward being to the downside. 4200, the risk reward is so one-sided to the downside that I'd be surprised if the market lets me get in. All there is to it. I also wanted to show you volatility, and this chart just does not look all that bullish, i.e. for higher volatility prices, which is another piece in the jigsaw that tells me that we are more likely to see 40-50 than fall apart. Absolutely, the stop in all vol should be 30.11. Okay, you can see on this weekly chart how, if I enlarge this, already 2 weeks, 30.11 was the absolute top. We couldn't go any higher than that. If we go higher than 30.11, I would really begin questioning my view that we're going to go higher towards 40.50. That's all there is to it. It's just such a lovely level, and 2 weeks in a row we've had, that we just couldn't get anywhere close to it. So I think the likelihood is greater, then we go and test down here towards the 20s and 19s, do some kind of an ABC down towards this kind of level, 2021, and then go back up, which tells me 40.50 is likely to trade. Finally, I wanted to show you this chart of the stocks. What a beautiful level 38.83 is. Let's just enlarge this area. To me, the likelihood of 36.24 trading is very, very high. And that is where I'm going to get rid of the call spreads I didn't buy a call spread. What did I buy? Yes, I bought a straddle. That's where I will get rid of the call side of the straddle. And then the puts will be free. So to me, that is a very, very good level to get rid of longs in Europe. And that should coincide with something like 40.50, I hope, in the SPX. I've updated all the levels. As I've told you, I think the 2s 10s is likely to be far more active than the 5s 30s, and I would look at the 2 10s as opposed to the 5s 30s. All the levels have been updated. I do think it's all peaked, but it's peaked in the short term. I mean, depends what you call the short term. I call that a month. I just can't see CPI being that high, and I just can't see, even if it is high, that the market doesn't say, well, it'll be reflected, the lower oil prices and energy prices in general will be reflected in the next month. So I really can't see that we're going to go through my red lines, and these levels are all updated. And if we don't go through the red lines, we get stability in the bond market. That is likely to promote a better tone in the technology sector. If you get a better tone in the technology sector, you get a better tone overall. And I do think that we get to that 40.50, possibly 41.15 area. I don't think you see 4200, because I will be so short at 4200, it's not true. Anyway, all the levels are updated. I would avoid gold. All I have in it is a bid, a stupid bid at 1680. No, I think it's 1684. And if they hit it, they hit it. But I really am not bothered if they don't. So all the levels are here. And of course, I will tweet you on Monday. Have a wonderful weekend.